Welcome to this explainer. Okay, today we are diving into a massive alternative financial system, and honestly, it operates on a completely different set of rules than what you're probably used to with conventional banking. Seriously, if you've ever wondered how it's actually possible to finance a car, buy a home, or even fund a multi-million-dollar corporate project without ever charging a single cent of interest, well, you're in exactly the right place. Let's get into it.
So why does all of this matter? Well, think about $7.69 trillion. That is the staggering projected size of global Islamic finance assets by the year 2030. This isn't just some niche, localized market. It's a rapidly growing sector playing a super vital role in the global economy, and it's expanding way beyond its traditional hubs in the Middle East and Southeast Asia.
But what's really fascinating is that the foundation of this entire multi-trillion-dollar industry actually stems from a single theological text. This one verse from the Quran states, Allah has permitted trading and forbidden riba, with riba translating to usury or interest. And from that one ancient decree, this incredibly sophisticated modern financial architecture was born.
All right, here's our roadmap for today. We're going to cover the core Sharia principles, the major prohibitions, the Islamic finance toolkit, Islamic versus conventional banks, and we'll wrap it all up with the big picture.
Starting right off with Section 1, the core Sharia principles, specifically focusing on asset-backed financing.
So there are 6 principles here, and they literally form the absolute bedrock of the system. First, there's a super strict requirement for tangible assets. Unlike conventional finance, where abstract debt itself gets traded around, here, every single transaction has to link to something physical, like property or a commodity. It's not just a compliance box to tick, it's about economic justice. You also have the strict prohibition of interest and a massive emphasis on risk sharing. Plus, you have to avoid speculation and ensure all investments are ethical or halal, which means absolutely no funding for industries like gambling or alcohol. And finally, asset recycling, to make sure an asset is continuously used in a productive way over time.
Now here's where things get really paradigm shifting. It's how this system views money itself. Under Islamic economic principles, money is strictly just a medium of exchange. It doesn't have intrinsic utility. It's definitely not a commodity that you can trade or rent out for a profit. Practically, this means money cannot organically make more money just by sitting there while time passes. To grow, it actually has to be put to work in a real, productive economic activity.
Moving on to Section 2, the major prohibitions. Basically, what is strictly forbidden?
The first, and definitely the most famous, is riba. Riba is defined as any increase in wealth that isn't related to engaging in a productive economic activity. This strict ban means there is absolutely zero charging or paying predetermined fixed interest on loans. The whole rationale here is equity. This rule was designed to protect the weaker party in a transaction and stop the unjust hoarding of wealth without taking on any shared risk.
The second major prohibition is harar, which translates to excessive uncertainty or ambiguity. Basically, if the details of a contract or the payoff of a sale are hidden in any way, the contract is completely invalid. The system demands absolute 100% transparency and perfect symmetry of information between both parties. Because of this, those crazy complex financial derivatives, futures, and options that are so common in Wall Street banking, they're naturally prohibited here.
And that leads us directly into the third prohibition, maisir, which means gambling and speculation. Any contract where your ownership of a good relies on, say, a roll of the dice regarding some uncertain future event is totally out. So things like short sales, highly speculative day trading, or just trying to profit purely from market volatility without any underlying economic substance, those are completely excluded from the system.
All right, Section 3, the Islamic finance toolkit. How do we actually replace interest with assets?
We've got what you might call the Big 4 Sharia-compliant contracts. These are the actual practical tools that replace interest-bearing loans. First is murabaha, a cost-plus sale, mostly used for everyday things like homes and cars. Then there's ijara, which is a leasing structure, great for equipment. We also have musharaka, a joint venture partnership that is basically perfect for business or startup funding. And finally, mudaraba, a profit-sharing model that's really often used for customer deposit accounts where the bank steps in as the investment manager. Let's actually look at how a couple of these work in the real world.
Okay, imagine you want to buy a car, but you need financing. Under a murabaha structure, instead of just lending you cash and tacking on a bunch of interest, the Islamic bank physically buys the car from the dealer and takes full legal ownership of it.
Then, the bank turns around and sells that exact car to you at the original cost, plus a clearly disclosed, agreed-upon profit margin. You pay the bank back in deferred installments. See what happened there? The bank earns its return not by lazily lending money, but by acting as an active trader and actually bearing the risk of ownership, even if it's just for a brief moment.
Next up is ijra, which is essentially a lease. Let's say a construction client needs some heavy machinery but doesn't want to buy it outright. The bank will own that machinery. The client then leases the right to use it for a set period, paying a fee. What's absolutely vital here is that the bank retains ownership and all the associated risks that come with owning it. Once the lease is up, the bank can recycle that asset and lease it out to multiple customers over time, which ensures the equipment has an ongoing productive economic utility.
Now, if you dig into official documents, like the glossary from the European Central Bank, you'll find a whole highly specialized vocabulary surrounding this, from terms like istniya for manufacturing to sukuk for Islamic bonds. Dedicated Sharia boards meticulously engineer every single one of these instruments. They have to make absolutely sure they are commercially viable without ever crossing into that forbidden territory we talked about.
Section 4. Islamic versus conventional banks. Let's do a direct comparison.
Honestly, the absolute most fundamental difference boils down to risk. Conventional banking operates on risk transfer. Think about it. If you take out a typical business loan, you bear all the investment risk. Even if your project completely tanks, you still legally owe the bank the principal plus that fixed interest. Islamic banking, on the flip side, operates on risk sharing. The bank and the customer share the risks and the rewards of the underlying investment. If the venture fails and there was no negligence, the bank actually shares in that loss.
And this completely shifts the dynamic between you and the institution. In conventional finance, you are stuck in a strict debtor-creditor relationship. The bank expects a guaranteed fixed return, whether you succeed or fail. But in Islamic finance, the relationship is fundamentally a partnership. The returns are never guaranteed. They're expected profits based entirely on the actual real-world performance of the asset or project. You earn through actual productivity.
The European Central Bank actually points this out perfectly in their reports because this system demands an identifiable physical asset for every single transaction. These banks remain firmly anchored to the real economy. They literally cannot endlessly multiply debt upon debt, which is a brilliant, natural way to curb rampant financialization.
And that brings us to Section 5, the big picture. Let's look beyond the balance sheet.
You know, it's absolutely vital to realize that Islamic finance is not simply a clever set of legal loopholes just to avoid paying interest. It's built upon a comprehensive, holistic, socio-ethical framework. The ultimate end goals of this entire system are fair resource distribution, social justice, and economic stability. It prioritizes the welfare of the community as a whole, demanding that wealth circulates through actual production, rather than just concentrating in the hands of the few people who already have capital to lend out.
So, that wraps up our explainer. But before we go, I want to leave you with a somewhat provocative thought. When we look back and reflect on past global financial crises, the ones heavily driven by excessive speculation, hidden risks, and toxic debt, could these ancient principles of shared risk, extreme transparency, and anchoring finance to real, tangible assets actually offer a more stable path forward for all of us? It's definitely something to think about. Thank you so much for learning with us today, and we'll catch you in the next explainer.